Dividend investing is a popular strategy for investors seeking a steady income stream, especially in today's low-interest rate environment. The goal is to invest in assets that regularly pay dividends, providing a consistent source of cash flow. When considering dividend investing, two major options stand out: exchange-traded funds, or ETFs, and individual stocks. Each approach has its pros and cons, and understanding the differences between the two is essential to building a well-rounded portfolio. First, let's dive into what dividend investing is all about. In simple terms, dividends are payments made by a company to its shareholders, usually from profits. These payments can be in the form of cash or additional shares of stock. For investors, the appeal of dividend investing is the predictable income it can generate, often on a quarterly basis. This regular income is particularly attractive to retirees or those seeking to diversify their sources of income beyond traditional savings accounts or bonds. Now let's compare the two major options, ETFs and individual stocks. Both offer the potential for dividend income, but they do so in different ways. Each has distinct advantages and risks, which should be weighed carefully before making a decision. ETFs, or exchange-traded funds, are investment funds that hold a collection of stocks or other assets. These funds are traded on stock exchanges, much like individual stocks, and they typically track a specific index, sector, or asset class. Dividend-focused ETFs are funds that include stocks of companies known for paying regular dividends. By investing in an ETF, you gain exposure to a diversified group of dividend-paying stocks in one transaction. One of the biggest advantages of investing in dividend ETFs is diversification. Since ETFs hold a variety of stocks, your investment is spread across multiple companies and industries. This diversification helps reduce risk because the performance of any single stock won't have a large impact on the overall performance of the ETF. For example, if one company in the ETF experiences a drop in stock price or a reduction in dividends, the overall impact on your investment is less significant due to the other stocks in the fund. Another advantage of ETFs is the convenience they offer. When you invest in a dividend ETF, you don't need to spend time researching and selecting individual stocks. The fund manager does this work for you, selecting the best dividend-paying companies and managing the portfolio. This makes ETFs a good choice for beginners or those who prefer a hands-off approach to investing. Moreover, dividend ETFs often come with lower fees compared to actively managed mutual funds. The expense ratios of most ETFs are relatively low, making them an affordable option for long-term investors. This is particularly important when considering dividend reinvestment, as keeping fees low ensures that more of your money is working for you over time.
However, ETFs also have some drawbacks. While diversification reduces risk, it also means you may not experience the same level of returns as you would by investing in a high-performing individual stock. Dividend ETFs generally provide stable but moderate returns, which might not suit investors looking for higher growth potential. Additionally, some dividend ETFs may hold stocks from companies that are less reliable in paying dividends. While ETFs typically focus on companies with strong dividend histories, not all companies in the fund may be equally dependable. On the other hand, individual stocks offer a more targeted approach to dividend investing. By selecting specific companies that pay high dividends, investors have the potential to earn more income from their investments. If you carefully select strong dividend-paying companies, you may be able to achieve higher yields than the average dividend ETF. Furthermore, some individual stocks, especially those from established companies with a long history of paying and increasing dividends, can provide a more reliable source of income. The main advantage of investing in individual stocks is the ability to tailor your portfolio to meet your specific goals. If you have a deep understanding of the stock market or a particular industry, you can hand-pick stocks that align with your investment strategy. This level of customization isn't available with ETFs, as they invest in a broad selection of companies. For example, if you're particularly interested in healthcare stocks or technology companies, you can focus your investments on those sectors. Another advantage of individual stocks is the potential for higher returns. If you're able to pick the right stocks, you could see your dividend income increase over time, particularly if the company grows and raises its dividend payouts. Some individual stocks also have the potential for capital appreciation, meaning their stock price could rise in addition to the dividend payments. However, there are also significant risks associated with investing in individual dividend stocks. Unlike ETFs, individual stocks expose you to the risks of single companies. If the company you've invested in faces financial difficulties, it could cut its dividend, or in the worst case, go bankrupt. This could have a major impact on your investment. Furthermore, selecting the right individual dividend stocks requires a lot of research and monitoring. You need to keep track of the company's financial health, its dividend history, and any changes in the business environment that could affect its ability to continue paying dividends.
This may not be ideal for all investors, especially those with limited time or expertise. Additionally, some individual stocks may not provide the level of diversification that an ETF offers. Holding only a few stocks can increase your exposure to market volatility, which may be uncomfortable for more risk-averse investors. When deciding between dividend ETFs and individual stocks, one key factor to consider is your risk tolerance. If you prefer a lower-risk, hands-off approach to investing, dividend ETFs may be a better option. They offer diversification, lower fees, and convenience, making them ideal for passive investors. On the other hand, if you're comfortable taking on more risk and have the time to research individual stocks, you may be able to build a more targeted and potentially higher-yielding portfolio by investing in individual dividend-paying stocks. Another factor to consider is your investment goals. If you're primarily seeking consistent income, dividend ETFs may provide the steady cash flow you're looking for, as they typically pay quarterly dividends. On the other hand, if you're interested in higher growth potential and are willing to actively manage your portfolio, investing in individual stocks might offer the opportunity for greater returns over the long term. One strategy that combines the best of both worlds is a hybrid approach. This involves investing in a mix of dividend ETFs and individual stocks. By doing so, you can benefit from the diversification and convenience of ETFs while also enjoying the potential for higher returns from carefully selected individual dividend-paying stocks. This balanced approach can help you manage risk while pursuing greater income and growth potential. In conclusion, both dividend ETFs and individual stocks can be effective tools for dividend investing, but they come with different advantages and risks. Dividend ETFs provide a convenient, diversified option for investors seeking steady income, while individual stocks offer the potential for higher yields and more customization. Your decision ultimately depends on your investment goals, risk tolerance, and time commitment. Whether you choose one approach or combine both, dividend investing can be a rewarding strategy for generating passive income and building wealth over time.